I really see the next big shift as not any different than what all industries are going through with generative AI. I think real estate has been a little bit slow to adopt, but it's exciting to see that many of our peers in Jamestown as well are adopting new technologies and forcing ourselves to do more with automation, to layer in AI capabilities, to layer in generative AI capabilities. I see this as supporting so many of our basic functions, like automating REIT questionnaires for our tax team, or automating our charts and graphs information for fund management. Just makes things much more efficient. And I wouldn't say it's not unique to prop tech, but I think it's unique as a global thing. And then the other thing I see with prop tech is sometimes it has a narrow focus, which is fine. But I do think starting to get beyond, in many ways, what people consider as prop tech, like parking technologies or EVs, and expanding into things like family amenities, or into things like construction tech, which some have done, but I think making it an even more collaborative space to move that work forward.
Well, in general, when interest rates fall, that's positive for real estate values. But the problem is that we are in such a massive political and economic and financial turmoil at the moment that is very hard to foresee. So strategically, what you need to do is to prepare for potential fluctuations in inflation, in interest rates, etc. So protect against inflation and protect your downside.
So the theme of our annual outlook is dawn of a new real estate cycle. And you can clearly see that in monetary policy. Almost all of the major central banks globally have moved towards loosening. The big exception of that is Japan, which is moving more towards a normalization, a gradual tightening, but it had been very different for a long time. You don't see quite that decisive move in long interest rates. And part of that is, the main driver of that is markets pricing in a soft landing, pricing in the strength of the economy. And in our view, it's not so much a pricing of the new US administration, but just resolving an inconsistency that, look, rates aren't going to fall rapidly if we don't have a recession. And so, what this means for property values and real estate capital markets is that we have a little bit more certainty on the path, or more of a gradual decline or easing of conditions as inflation has cooled, but we don't have the sharp decline in rates that we saw after the GFC. So, valuations have kind of generally reached bottom with some variation by geography and sector, or prices have reached bottom. Valuations are catching up. They're closer to catching up depending on the sector and depending on the type of fund. We see that they're much more accurate in open-ended funds today than they have been in a long time. So the direction of travel is positive, but the pace of travel will be slow because we see a kind of high-ish for long rate environment. So interest rates are not likely to sort of fall as quickly as they had after the GFC unless we have a recession.
Well, I think Asia, obviously I'm pretty pro-Asia, but I think that fundamentally too, there are a lot of reasons why I should be bullish. One is, as I mentioned before, transaction volumes are up. I learned a long time ago, and when you've been in this business a long time, you see multiple cycles, that real estate pricing is really a function of two things. Physical supply and demand, is there too much space for the demand? And then two, capital supply and demand. And over the last couple of years, in Asia, in our sector, there's been too much supply and too little capital. And so developments have effectively gone down significantly. If you look at a market, for example, like Korea, where in Seoul, there's about 3 or 4 million square meters of excess capacity in the logistics space. But when you look at the construction starts and completions that are forecast for 2025, 26, 27, it's going off of a cliff, and that should all be absorbed in the next 18 months. So we think, again, that the next 2 years are going to be very, very interesting investment opportunities.
It seems like the big trend is to diversify. The menu of options to invest have widened since the past, and people are eager to start deploying again and are being able to move beyond just blocking and tackling their existing portfolio problems.